All right, so we're super happy to have Pierre-Olivier Weill giving us second set of SaMMF lecture series on OTC market theory. Let me remind you of the format. So it's gonna go until 2. It's a 1.5 hour lecture. During the lecture, please feel free to interrupt and ask questions from Pierre using the raise hand feature. And just remind us, please, of your names and affiliation when you do so. And then a reminder that next Wednesday, we have Ben Lester, who's gonna also continue this lecture series on OTC market theory. All right, so thanks a lot for everyone for attending. Pierre, the floor is yours. Let me stop sharing.
All right, so thanks a lot. The lecture might last a bit less than 1 hour and a half. It's planned for more, an hour, probably a little bit over time, and then we can have open questions. But please don't hesitate to interrupt me while during the lecture. All right, so let me start with a definition. So what do we call over-the-counter market? So over-the-counter market refers to decentralized security market. What decentralized means is that trade in market occur in small groups. The canonical example of a small group is an investor and a dealer, an intermediary bargaining over the terms of trade. So this is in contrast to the way we like to think about valuation market in textbook, and in contrast to the way, say, equity are traded in practice in all-to-all continuous auctions. So because trade in decentralized security market, in OTC market, occurs in small group, price setting often involved a form of bargaining, or in some case, a bit of auction theory. And in addition, information is often lacking in the sense that investors often have limited information about terms of trade in similar transactions that occurred recently. So this issue of lack of information or lack of transparency or opaqueness was at the center of the regulatory discussion on OTC market for the last 20 years. Which assets are traded in over-the-counter market? Well, most fixed income securities are traded in over-the-counter market. Part of equity, it turns out, are traded over-the-counter as well, and some derivatives are traded over-the-counter. Just to give you a sense of the size of OTC market, in this slide, you see a picture from a survey paper of mine published 2 years ago. And the picture is an attempt to break down the market capitalization of publicly traded securities in positive supply between centralized and OTC market. So centralized would be the dark bar, and OTC market would be the gray bar. So there are some judgment calls that have to be made in order to do that, to draw that picture. But the visual impression I'd like you to have is that, so first, you have this massive dark bar for centralized market. These are equity. But at the same time, the sum of the gray bar turns out to be larger than that of the dark bar. So it turns out that in 2018, there was more market capitalization, more securities in value traded in over-the-counter market than in centralized market. What happened since 2018? Well, what seems to have happened in equity markets is that we have more trading in off-exchange venue, and some of them over-the-counter. There's some recent document by SIFMA that discussed that recent trend. And in over-the-counter market, securities that were traditionally traded over-the-counter, such as corporate bonds, started trading more in electronic platforms. So corporate bonds started, a larger fraction of corporate bond volume now occur in electronic platform. But then it turns out that even on those electronic platforms, trading is not really all to all. So it still turns out to go through dealers. There's a recent paper by Undershot, Livdan and Schurhoff that make that. So OTC markets are important, they are large. They also raise policy questions. So over the last 20 years, I cite 3 important policy questions that were raised in the context of over-the-counter market. The first one I alluded to a bit earlier is that of price transparency. So, in the early 2000s, there was a regulatory discussion regarding the magnitude of transaction costs in OTC market. They were thought to be too large, or it was argued that intermediary had perhaps too much market power, and the solution that regulator proposed and implemented was to make OTC market less opaque, to have intermediary report the price of their recent transaction promptly after the transaction occurred, and those prices would be broadcasted to the investor community, so that investor would think in better position to negotiate better terms of trade. Another policy question that came up in the last 2 decades is the one of market resiliency and systemic risk. So those questions came up around the great financial crisis, when we saw markets functioning badly, and especially, people argued, over-the-counter market. So we saw, for instance, corporate bond, a massive increase in transaction costs. We saw some market freezing altogether, market for mortgage-based security. And we saw some market, there was also the discussion that some OTC market for derivative perhaps created a systemic risk, a risk of chain of default amongst financial market participants. So that prompted a discussion on how to design the market better, maybe information, maybe how transactions are cleared and settled, so that to improve the stability or resilience of these markets. And finally, there's a third policy question that came up more recently on the unintended consequences of banking sector regulation. So that came up after the great financial crisis, because the great financial crisis prompted a round of banking regulation to make the banking sector more stable. So as part of that effort to curb speculation in the banking sector or increase financial stability in the banking sector, banks were required to banks were subject to regulation that made it difficult for them to expand their balance sheet very quickly, to borrow lots of money and use that money to buy lots of assets very quickly. There were new liquidity ratio, there was the Volcker rule, all that made it hard for banks to buy assets very promptly in financial markets. Those regulations were here for a good reason, right? So it was to make banks safer, more financially sound. But very quickly after they were put in place, market participants and economists argued that, well, those regulations would have an unintended consequence. And the unintended consequence that banks would have a harder time perform their role of liquidity provider if a crisis were to hit the market. There were very large selling pressure, and bank would need, or it would be socially useful for bank to buy lots of assets to alleviate that pressure. So for the first few years after the regulation, there was no massive selling pressure hitting the market. So everything seemed to go fine until the beginning of the COVID-19 crisis, where there was massive pressure in fixed income market, in both treasuries and corporate and municipal bond market. And what we saw is, well, we saw that indeed intermediaries were unwilling or unable to expand their balance sheet quickly and buy lots of assets, and we saw as a result transaction costs go up by a lot. So that those observations prompted a debate that's still ongoing on how to design bank regulation in a way that does not have that unintended consequence that liquidity could dry up in markets when faced by large selling pressures. So to answer these policy questions and many other interesting applied questions, and some interesting theoretical questions as well, we have by now a rich theoretical toolbox. And the toolbox draws from two strands of theoretical literature: search theory and network theory. So Gabriela worked on network. Some of you work on search. The two are not mutually exclusive. In fact, there are papers that try to draw on from both strands of the literature, but they seem to have distinct advantages. So search seems to be particularly useful to think about dynamics, to think about many different types of price setting mechanism. And also, so I know some of you work with Lagos and Wright to integrate those OTC market in bigger general equilibrium structure. But search theory always think about some strategic interaction, but not all. So to think a bit about all type of strategic interaction more precisely, network theory is often more useful and more precise. So both are exciting and very interesting approaches. Turns out that Ben and I are specialized in search theory, so we're going to focus on that. But later this year, I saw on the search and matching in macrofinance website that Marjana Rostek is going to give a lecture. Marjana is going to speak about thin market, and thin market have application to network market as well. I'm assuming that she's going to speak about her work in that area. All right, so before I dive into the formal part of the lecture, I'd like to pay some tributes to some earlier work that's used or predated the contemporary search and matching models that we're all using for the last 20 years. So perhaps our grandfather is for all of us is Dempsey, who in 1968 wrote an important paper in the QJ on transaction cost. So Dempsey was not interested in financial market as his main research agenda, but he thought it was a good laboratory to think about transaction cost. I remember because when I read at UCLA in 2006, I came out of the elevator and I see in front of me the office of Harold Dempsey. I said, oh, wow, that's Dempsey I cite all the time. And then I went and asked him, oh, so why did you work on that? And say, oh, yeah, that's just a good lab to think of the cost of transacting. So Dempsey, in his QJE paper, put forward the idea, and that idea is, all over the place in search model, that when we trade in financial markets elsewhere, we do not trade with the entire demand and supply curve. Just a subset of agents or investors in financial application are present at any point in time in the market. Why? Well, probably lots of good reason. They have other things to do. They want to attend an exciting lecture online. They have to work. They're not in the market all the time. And as a result, we can't reach the final holder of the asset immediately, and we have a demand for what Dempsey called immediacy, for quick exchange. And this demand is not satiated because not everyone is in the market immediately, and that demand is in part fulfilled by intermediaries. So Dempsey's paper, when you read it, you realize it's written in a completely different style from what we do these days. It's not formal at all. It has beautiful supply and demand curves, but no formalism. And during the 70s, a number of papers have tried to formalize the idea of DEM sets. I cite 3 of them on this slide, and those 3 papers, the reason I chose those papers is because they started to use the same tools that we're using nowadays. So they started to think about investors, contacting others at Poisson arrival time, having to negotiate or think about the terms of trade, etc., etc. It's not what we would call search, but the tools are there. So there's this paper of Garbade and Silber, for instance, that explicitly, in fact, use the McCall model to think about the treasury market. The search literature took off in the 1980s with a famous paper by Rubinstein, Wolinski, Diamond, and others. Those papers, for the most part, in the 1980s and 1990s, the search literature did not address security market. There are some important exceptions, and I cite a few of them on the slide. But the focus of most of the literature was on labor, monetary economics, not much on security market. Works on security market started more intensely after Duffy, Galeano, and Pearson wrote and published 3 important papers about 20 years ago. So I went back preparing this lecture to the PDF that Duffy has online of his paper. And the first version of the paper that's published in 2005 was written in 1999. So, we're almost 23 years after the first draft. So in this lecture, and next week, I'm assuming in Ben's lecture as well, we're going to draw on, not on the Galeano percent, but a generalization of it, which we developed with Ben Lester and Julien Hugonnier in a series of papers. And today, I'm going to start with a discussion of asset prices and liquidity in maybe the simplest formal representation of an over-the-counter market, what we like to call a semi-centralized OTC market. So it's called semi-centralized because some trade will be OTC-like, but other trade will be Valorasian-like. So it's not maybe all the way to the OTC market you'd like to model, but it turns out it's very tractable, it's quite realistic, and a lot of important intuition emerge already in that model. All right. Now, please raise your hand, ask questions, clarification if you have. All right. So I'm going to start with the formalism, and the formalism is the first piece of the formalism I'd like to introduce. Is the model of demand. So I'm going to study how we model investors' preference. So the way we think about investors' preference in this class of model is by imagining that the economy is populated by a measure 1 continuum of infinitely lived and risk-neutral investors who discount the future at the same rate, equal to R. And I'm going to assume here that investor can hold either 0 or 1 unit of the asset. So the demand is going to be very simple. I'll speak briefly about other models later. And the asset is in supply S, a number between 0 and 1. And to generate trade in this model, we're going to imagine that investors enjoy some utility flow for holding the asset, but that utility flow is time varying. So more precisely, if an investor holds 1 unit of the asset, that the flow utility of that investor for the asset will be denoted by delta. So that means that we're imagining that the investor enjoy just delta per unit of time for holding the asset. But delta changes over time, namely with Poisson intensity gamma, an investor is going to draw a new type, delta prime, according to some CDF, which we denote by F, on a support that we normalize to be 0, 1. And those type will change, IID across investors. So they are not correlated across investor. Investors have those idiosyncratic change of types. The CDF here is any CDF you'd like. Could be continuous, could have atoms, could be a mixture of continuous and discontinuous CDF, any distribution. And for simplicity, I'm going to assume that the initial distribution of type is equal to stationary distribution. And in this case, the stationary distribution is just equal to the distribution F, according to which new types are being drawn. So one question that comes up immediately is, what does delta means in the context of financial asset? So financial asset paying cash, what does it mean that my delta is for cash, varies over time, is higher sometime, etc., etc. So there have been a number of micro foundation proposed in the literature. Those micro foundation comes in 3 broad categories. So there've been a micro foundation for delta. There are micro foundation for delta that interpret delta as representing heterogeneity in beliefs. This requires a little work, but the idea is that investors have different views about future payoff of the asset, and delta represents how optimistic they are about the payoff of the asset when that payoff realizes. Another interpretation of delta is in terms of hedging. So the idea here is that investors do not hold that asset in isolation. They hold other things. So imagine banks have other things on their balance sheet. So say they have lots of loans on their balance sheet, and how much loans they have impacts how willing they are to hold the asset that is traded in this OTC market. So if that asset is a treasury, and the bank has a lot of loan on its balance sheet, that presumably the bank is already holding a lot of interest rate risk and doesn't want to hold too much treasuries. That would be a low delta, and vice versa. So that hedging interpretation has been developed early on already by Duffy, Gallagher, and Pearson, and perhaps one of the most complete development of that interpretation is due to Rémi Pras in his dissertation in Lausanne a few years ago. And lately, I know some of you work on Lagos Right, there is a third interpretation in terms of consumption opportunity. So to develop that interpretation, you need to think a bit more deeply about the joint consumption and portfolio choice problem of investors. And the idea here is that some investors have periodically consumption opportunity, and to realize those consumption opportunity, they have a need to sell their asset in exchange for cash. So that would correspond to low delta. So you don't want the asset too much and want to transform the asset into cash in order to consume, and vice versa. And so that's that interpretation of delta in terms of consumption opportunity is something that comes up in model of Lagos Right, when agents can go to an over-the-counter market to liquidate their asset before they're able to use the money in order to buy consumption. So I cite Jeremy Klaus and Aaron Brook over here, but Shengxing also has work in that area.
Sorry, Pierre?
Yep.
Yes. Hi, everyone. This is Santiago from UChicago. I have a question on, given that we're giving interpretations for the security, like for the delta, for the flow utility, what determines that a security or an asset is traded in a centralized or a decentralized markets? Like going back to your introduction, like why these markets exist, and is there something particular to the assets that make them be traded here that rather than somewhere else?
All right, so that's an excellent question. So there's been a bit of work on that question. The type of story that people would tell is that say bonds, for instance, are natural candidate for trading in OTC market because they are very finely differentiated security. So that's a bit of an IO intuition that when you have finely differentiated goods, it's hard that are not very standardized. It's hard to organize and a centralized exchange. And why are bonds very finely differentiated is because even the bond, you can go actually it's on the website of FINRA and try to get bond quotes and just observe, pull out bond quotes from trades, the trade reporting and compliance engine, and you just say I like quote for bonds by target, and you have like 2 pages of different bonds issued by target that differ in their maturity, that differ in their coupon, that differ in their seniority, and differ in a bunch of other dimensions like callability, etc. So that's one story that was given. The truth is that what happened is that fragmentation occurs in various dimensions. That some assets tend to be traded more predominantly in OTC and in centralized market, but it's also true that the same assets are traded in different type of venues. And for equities, are traded both on exchange and off exchange. So that also raised the question that's related to yours, which is, for what type of transaction do I want to trade on exchange versus off exchange or in over-the-counter market? And then there are stories related to trade size, or you wanting to not have too much information leaking out to the market when you trade. So you take advantage of the opaqueness and the anonymity of trade in OTC market, and that has some value. So that question is important, because a bunch of regulation intends to make market more centralized. So to understand the unintended consequence of those regulations, you need to understand the demand for decentralized market, right? So what are you depriving investor of by forcing them to trade in centralized market, even though the centralized market looks like this wonderful out of the blue market that we all learn in the first year has so many good properties. So that's it's a fundamental question for all the policies surrounding OTC market. So yeah, as I say, there's a bit of casual empiricism on the topic, a bit of theoretical work on that. I don't think we have converged on one, one answer that everyone would agree on. Oh, Ben. All right. Ben will speak about that more next week. Very good.
Hi, right. This is Trini from LSE. I want to ask a follow-up question on the delta. So I guess the delta is one like a modeling strategy to make those investors trade the asset. And in the literature, we saw there are some other like modeling strategy, like heterogeneous discount factor, or like outside investment opportunity or something like that. Can you say a little bit on like how to choose among those different modeling strategies when writing down models?
So this first draft of the Figurano person had heterogeneous discount factor, it turns out. So and then they moved on to something like that's similar to delta. The little delta assumption turns out to be very tractable. I think it's mostly for practical reasons that we converge on that, and then we have those interpretations in the back of our mind to justify them. Even the heterogeneous belief, and sometimes, you know, the discount factor delta are so the heterogeneous belief interpretation, and that's something that is done in a working paper by Julien Hugonnier in 2013. What is an interpretation where agents have heterogeneous belief about the growth rate of some dividend, geometric Brownian motion dividend. I think about the drift. Was it that? I think so. And then so that ends up, you know, formally being very similar to change it in discount factor, it turns out. But the little delta turns out to be very tractable. And you'll see it leads to very simple formula. And there's a sense that it does not do too much violence to the results. You know, of course, you need to do the math on the side to make sure that's indeed true. All right, so with those assumptions, I'm going to show you the objective more formally. If you plug given risk neutrality, we can plug the budget constraint into the objective, and what we obtain at the end of the day is the following intertemporal utility. So it's an expectation, and the expectation is over the process for delta, but in a search market is also going to be over the arrival of trading opportunities. We have an integral from 0 to infinity because we have infinitely lived investors. We have a discount factor that take the usual exponential form in continuous time. And in the curly bracket, you see the utility flow for the assets. That's delta times Q. Q is the holding, 0, 1. And then the second term in the curly bracket are all the payments that the investor make or receive when his or her asset holding changes. So when dq changes from 0 to 1, we have dq equal 1, then we subtract the price that is negotiated in the OTC market from the objective. So you see, you know, this is very simple, and we'll see very workable theoretically. All right, so let me comment very briefly on two related specifications in the literature. The first one is that of Duffy, Galliano, and Pearson, the one that's published. So, you know, in the first draft, you had difference in discount factor, but then they moved to a specification when investor had two different utility flow, either low or high. So that turns out to be a special case of the model I'm presenting today, because I'm assuming a CDF that can take any form. So in particular, you could have two atoms, one at the low delta, one at the high delta. Another specification is due to Garleanu and Lagos and Rocheteau in two papers that were written more or less at the same time and published in the same years. So what Garleanu and Lagos and Rocheteau did is that they restricted, they relaxed this assumption that asset holding are restricted to be 0 and 1. They allowed for an extensive margin, a continuous choice of asset holding. So the way you do that is by specifying a utility flow function now that depends on delta, but also on a Q, and Q is a continuous variable. So it turns out that the setup I'm presenting today is a special case of Garleanu and Lagos and Rocheteau if the utility flow takes a Leontief form. So if the utility flow is delta times the minimum between Q and 1. And the purpose of the Leontief form is that it ends up making those restricted asset holdings 0, 1 actually part of an optimal demand. And so they make those 0, 1 holding optimal. And so the point here is that what I'm presenting today is not separate from Garleanu and Lagos Rocheteau did, but you know, is a special case of their work in case the utility flow function is Leontief. All right, let me first start with an important benchmark model. So I know I said we would hear about OTC market, but to understand what OTC market do and how pricing in OTC market, we need to first understand what happened when there are no OTC market frictions. I'm going to speak about the benchmark centralized market. So we'll have this benchmark in mind all along this week and next week when Ben will present. So when we think of centralized market, we think of the Arrow-Debreu market we study in the first year of the PhD. So we imagine that investors can trade continuously, so that's an all-to-all auction, at a price P that they take as given. So the objective is the same as the one I showed you before, except that I'm assuming that P is always the same in all transactions. So when you look at the objective that we had before and do an integration by part, what you end up is with an equivalent objective that you see on the slide. So let me correct the typo. I'm assuming that P is constant here. And that equivalent objective take the following form. It's the first term of the objective is P times Q0. So that terms means represent the value that investor get by selling all their holding at time 0. And the second part of the objective that you see over here is the value that investor get by continuously buying and selling their assets. So what we imagine here is that at any point in time, investor choose their holding, QT, they pay the price, and then at the end of a small time period of length dt, they resell their holding. And then, if they want the same, they buy it again, and then resell, and buy it again, and then resell, etc., until infinity. And so what we're doing here is that we're representing the problem in an equivalent way. Instead of saying that you buy and hold for a while and then sell, we just say you buy, you sell, you buy, you sell. But this is just a different way to account for the plan and the budget consequences of the agent's plan. But when you do that representation, the way you think about the cost of holding the asset is a bit different. What you have is that during a small time period, the cost of holding the asset ends up being equal to R times P. Why? Because R times P is what you end up paying for holding the asset if you buy at time T and resell at the end of the period. So what you end up paying basically is the interest rate on the price, but nothing else, right? Because you recover some of your initial cost by selling at the end of the period. All right, so why did I do all that? It's because once you write the objective in this way, optimization becomes trivial, right? Because QT just enters in the term of time T and nowhere else. So you can maximize the objective point-wise. And so the demand of investor is very easy to solve for. Investor choose to hold 1 unit of the asset if the price is low relative to their utility flow. So formally, that means that RP is less than delta. They hold either 0 or 1 unit if the price is equal to delta. And they hold nothing if the price is too high, if it's above their current delta. So what you see is that all investor with a delta that is high enough, so in this case larger than R times P, find it optimal to hold the asset, and delta below RP, they don't hold the asset. So we have a very simple market clearing condition. We also have a very simple pricing equation. The pricing equation is that the price ends up being equal to delta star over R, where delta star is the threshold delta above which investors find it optimal to hold the asset and below which they don't. So the threshold delta that you see in this equation, the delta star, is what's typically referred to in the literature as the marginal investor. It's the investor who currently is indifferent between holding the asset or not. And what's striking about that formula is that, and it's a classical result, is that the price ends up set by some as a present value of utility flow of a hypothetical investor who keep delta star forever. But there's no investor in the market who keep delta star forever. But it is as if the price were set by such an investor. Okay, so here is a picture of the equilibrium. On the left side, you see a CDF, so the CDF for a delta in the population. I assume here it's continuous. And delta star is the delta such that the cumulative number of investors above delta who hold 1 unit of the asset each is equal to the supply. So that's how the market clears. So something I would like to discuss regarding the pricing in variation market, and I want to discuss that because it's an important observation to understand the effect of friction on asset price, is the difference between the asset price and what I would call in this slide the buy and hold utility for the asset. So what's a buy and hold utility? Is what it should be. It's the utility you get as an investor when you buy the asset and hold it forever. So why would you hold it forever? Well, we don't know, but you know that's what you like, what you get if you were to do so. So this is formally just the present value of utility flow that the investor gets by holding the asset forever. It turns out, after you do the calculation, that you can write it as a sum of two terms, delta over R, so that's the utility flow you would get if you kept your delta forever. But as an investor, you do not get your delta forever, you revert to the mean. And when you change your delta, you get on average E of delta, the average delta, and that's the second term. Right? So it's a weighted sum of the delta you currently have and the delta you expect to have, and the weights over here reflect the discounted amount of time you expect to have your current delta or another delta. So for instance, if you switch type very quickly, then you'll spend most of your life with the average delta or with some other delta equal to E of delta on average, and the weight on the second term is 1. All right, so one observation that that many people have made, actually it's an observation that's been made a lot in the heterogeneous belief literature, is that there are some cases in which the price can be larger than the buy and hold utility of any investor in the market, even those investors with the highest delta. So formally, if the supply is close to 0, then the marginal investor has a very high delta. Say in this case, remember, I assume the support of delta is 0.1. So the price ends up being equal to 1 over R. But 1 over R, when delta is, when delta is bounded above by 1 and investor mean revert, is higher than all the U of delta, is higher than the buy and hold utility of everyone in the market. So, that puzzled some economists. Some economists interpret that as a bubble when delta is interpreted in terms of heterogeneous beliefs. How come that is economically possible? How is it the case that the price can exceed what everyone would be willing to pay to hold the asset forever? Well, the answer is because no one holds the asset forever. The buy and hold utility is not what anyone will get because agents can go in the market and trade. And so the buy and hold valuation of all investor does not represent the optimal use of the asset. So if you start with a high delta equal 1, and then your delta falls, you revert to the mean, then what will you do? You will sell the asset. To whom? Well, to a guy with a very high delta. So that's how the price can be very high. There's an option to retrade. So the option to retrade is important here in the variation market. It's also going to be very important in the search market. In a way that I will make precise in this lecture, the search market will allow us to vary the option of retrade continuously from a situation in which prices are set by buy and hold utility. So imagine a very large search friction is super high super difficult to trade, to variation pricing, centralized market pricing. Imagine a situation in which search friction make it not very severe and trade is very easy. So, yeah, go ahead, Maya.
So one question I have is that, is there an implicit assumption here that the state of the economy is the same all the time? The aggregate state stays the same, and the only thing that changes is the investors' valuations.
Yep, that's right. We start, and so the states stay the same, and so that's this is what the assumption that was shown earlier, that we start with one way to it manifests itself in an assumption I made earlier, that we start with a distribution of delta that's equal to a stationary distribution. So we start with it, but yes. So what you ask is very interesting. There's been some work on that, on what happened when the state changed. So for instance, in my introduction, I spoke about a moment of high selling pressure in the market. Nothing like that here, or anyway, it's not that the selling pressure changed, right? It's all, the supply, the demand and supply of asset originating from investor is the same all the time. So one way to think about on aggregate, so individual, it changed from individual investor, but the aggregate demand or supply curve doesn't move. So introducing the type of shocks you have in mind is a natural way to think about temporary selling pressure in the market. So there's a relatively small part of the literature that dealt with those questions. All right, okay, very good. So let me move on to what we call a semi-centralized market. So here is the market structure I'd like to consider today. Ben will study another one more sophisticated next time. So I'm going to imagine that investor trade through intermediaries that are called a dealer, and those dealers are not the final holder of the asset. I assume that they derive a flow utility equal to 0 from the asset. And moreover, and that's what makes this market structure relatively easy to work with, I'm going to assume that dealers have access to a centralized inter-dealer market. So for them, they can trade instantly together. Investors, on the other hand, are the one who will face a search friction. I will assume that investors have to trade through the dealers in the following way. Investors are going to make contact with dealers at Poisson intensity lambda. Those Poisson contact time are independent across investor. And when they meet a dealer, they are going to bargain over the terms of trade, and I will denote by theta the Nash bargaining weight of the dealer, the Nash bargaining power of the dealer. So that representation of the market is, maybe simpler than you'd like. However, it's not a bad description of many OTC markets. So it turns out that a lot of OTC markets are essentially intermediated by dealers. And as I mentioned earlier, even in corporate bond market, in electronic corporate bond market, where in principle you can trade with everyone in the market, a lot of the trading ends up being intermediated. And it turns out that the trade between dealers seems to be, according to measure of price dispersion, etc., more efficient than between dealers and investors. So as a first pass, it looks like a relatively accurate description of over-the-counter market. There's a bunch of reasons to go beyond that, and Ben will cover them next week. All right, so with this market structure, we can write a Hamilton-Jacobi-Belmont equation for investors. And the Hamilton-Jacobi-Belmont equation are shown on the slide. You see two of them. One for an investor who holds 1 unit of the assets, that's a subscript 1, and currently has utility type delta, and one for an investor who holds 0 unit of the asset and current utility type delta. So the first Hamilton-Jacobi-Belmont equation is written in the usual way. On the left side, you have the flow value of being in that state. So holding 1 unit of the asset, utility flow delta. And the right-hand side, you have a decomposition of the flow value in its various components. In this case, there are 3 components. The first one is, well, you enjoy the utility flow delta. The second component is that your utility flow may change. So with intensity gamma, you draw a new utility flow according to the CDF F, and your value changes from being V1 of delta to V1 of delta prime, where delta prime is a new utility flow. And the third term is here because of the option to trade with dealers. So with intensity lambda, if you own an asset, you make contact with dealers. So remember the 0-1 assumption about asset holding. So the only trade you can do with dealer is sell your asset. That's it, because you can only hold 0-1. So if you trade, it means that you move from 1 to 0. And if you move from 1 to 0, if you choose to trade, then what do you get? You get the selling price, that would be B, a bid price. You become a non-owner of the asset as V0, and you lose your current value, V1. And do you always trade? Well, no, right? You always have the option of not trading, which gives you a net utility of 0. On the second line, you have the corresponding Hamilton-Jacobi-Belmont equation for an investor who does not hold any unit of the asset. That investor doesn't have any utility flow because it doesn't hold anything. The investor might change type as well. An investor might trade. The difference here is that since the investor doesn't hold any unit of the asset, if that trade occurs, then it's a purchase. So the investor moves from being 0 to 1 and pays a price, an ask price, to acquire the asset. So how, okay, yeah, so remember we spoke about trade option, where we see the trade option here in the third term. We see a trade option for buyer and a trade option for sellers. So that's, it turns out, very important. There are 2 options to retrade, on the buy side and on the sell side. And both will have an impact on prices. It will turn out that they will have opposite impact on prices. So I have those 2 prices, B and A. How are they determined? They're going to be determined according to Nash bargaining. The Nash bargaining equation for the price, it turns out, has a very simple form. The equation says that So this is for the ask price, but the same equation holds, it turns out, for the bid price. The ask price is equal to 1 minus theta times P, where P is the inter-dealer price, plus theta times the reservation value of an investor, where the reservation value is defined as the difference between the value of owning and not owning. In other words, is the difference it makes in your value to own the assets, the value of owning versus not, and behaving optimally. So what you see is that the price, if your theta as an investor is, if the theta of dealer is equal to 0, so if dealers have no bargaining power, the investors are able to trade at a price that's equal to the inter-dealer market price, that would be P. But because dealers have some bargaining power, the price will, on the ask side, be in general higher than inter-dealer market price. You'll have to pay a bid-ask spread, and that bid-ask spread will depend on your reservation value. So the maximum price you're willing to pay is the value of owning the asset versus not, and behaving optimally. So, all right, so on this slide, you see another Hamilton-Jacobi-Bellman equation that's obtained from the previous one by subtracting the Hamilton-Jacobi-Bellman equation of non-owner from the Hamilton-Jacobi-Bellman equation of owner. So we calculate V1 minus V0. And when we do that, we obtain an HJB equation that's very similar to the previous one. It has, but now it's for the reservation value. It has the utility flow. It has change in reservation value associated with changes of type. And it has the terms associated with trading opportunity. So that term, you have to remember, is a difference between the option to trade as a seller, that's the option that an owner has, and the option to trade as a buyer, which is the option that as a non-owner has. Okay, so I'm now going to speak about that term in the blue box, and I want to make 2 points. First, you see that the A and the B have disappeared. Why? Is because I substituted the expression for A and B in terms of P, the inter-dealer market price, and reservation value. And when I do so, what I obtain is that instead of lambda in the expression, I have lambda times 1 minus theta. So what this expression shows you is that trading through dealers with bargaining power theta is, from the point of view of calculating HJB equation, equivalent to assuming that you can trade directly in the centralized market, but with an intensity that is adjusted down, that is equal to lambda times 1 minus theta. So that sort of adjustment to intensity is very common in search and matching model. When you study Diamond, Morton, Pissarides, you had job finding rate multiplied by bargaining power, etc., etc. It is particularly significant in the context of financial market, because a common criticism about those search and matching market is that, come on, it's very easy to go in the market and trade. You can contact people and get a quote very easily. So yes, that's true. But if the dealers with which you trade have a lot of bargaining power, then it is as if you were trading in a market with lots of friction. So what that means is that it's not only the physical speed at which you contact dealers that matter, it's also the market power of dealers that matter for the determination of pricing. So from now on, the search intensity that will appear in all the formula will always be bargaining adjusted. So adjusted for the bargaining power of dealers. So that's the first remark I want to make about this term. It's for the lambda 1 minus theta. The second remark is P is about the second part, P minus the reservation value. So notice that on the previous slide, the option to retrade, they were always positive, right? Because you can always refuse to trade. That was a max of something on 0. The max of something on 0 have disappeared here. So, that term can be positive or negative. And why? It's because it's the difference between two options to retrade. It's the difference between, because we're calculating the difference between V1 and V0 is difference between the option to sell and the option to buy. And that difference can be positive or negative. Well, in fact, if you're a delta that will always sell, then the option to buy is 0. You don't want to buy. So the only option that matters is the option to sell, and the term is positive. So that's what happens if you are a seller, so if the price is above the reservation value. And if you are a buyer, then it's the opposite. If you are a buyer, then the option to sell doesn't matter. So the only option that matters for you is the one for buying. So in the difference, the terms become, so in the HJB equation, that term becomes negative. So the fact that the term for trading opportunity can be positive or negative is very significant economically, because it means that search friction can have either a negative impact or a positive impact on reservation value. And when you think about the economics of the problem, it makes sense. So if you're a seller, right, if you mostly value the option to trade, to sell, then having access to a faster search market gives you the opportunity to find higher price at which you can sell. So that should make you less willing to sell, so increase your reservation value. But if you're a buyer, so you value mostly the option to buy the asset, then a better search market, a higher lambda, gives you the opportunity to find lower prices. So it should make you less willing to buy today, and that should lower your willingness to pay, and that should lower your reservation value. Yes.
I have one question. So
okay.
Even though we are using the Nash bargaining here, in contrast to the Lagos ride, when you use in Lagos ride, when you use the Nash bargaining, we used to have hold up problem, which have some inefficiency. But the derivation result you got there looks like the result from the client bargaining and doesn't really have the inefficiency from the hold up problem. And my question is it because of the centralized interdealer market and it cut out some inefficiency, and it turns out that there's not that much inefficiency compared to the Nash bargaining in the
so I think it's not because of that, because even if trade is fully decentralized in this setup, you'll still have efficiency, it turns out. It is because of the 0-1 asset holding assumption. So it's like in the Diamond Morton PCRS, you have no entry, and all the worker firm pair that should form, they do form. So it's because there's no intensive margin.
Okay.
If you go to the paper of Lagos and Rocheteau in 2009, in that paper you have inefficiency, and you also have a perfectly competitive interdealer market.
Okay.
And the inefficiency comes from this intensive margin, from the possibility of choosing the amount of assets you want to.
Thank you, Ben.
You would have inefficiency here as soon as you introduce entry or search intensity decision or things along those lines. Because although they do the right trade here, agents have private values for those trades that are not in line with social values.
Okay, and in addition to that, I have one more question. So it seems like because of the, please correct me if I'm wrong. So it seems like because of the interdealer market is centralized, the counterparty I think it might be it could be possible if we decentralize everything, then counterparty's evaluation for the asset, like counterparty's delta, could be better if it is fully decentralized. But
yep, that's right.
But it is the semi-decentralized because the dealer market is centralized, and we only care about the buyer's idiosyncratic shock, right? Am I right?
Yeah. So let me go back to this this formula for the ask price. So economically, what that formula says is that the price is a convex combination of the reservation value of the two parties in the trade. One is the reservation value of the dealer, and one is the reservation value of the investor. What's the reservation value of the dealer? Is a centralized market price, because the dealer has access, whenever the dealer buys the asset, he can just sell it on the interdealer market. So the value of owning the asset versus not for the dealer has to be equal to the market price. So in a fully decentralized market, as you said, you'll trade with counterparties drawn at random from the population, and they will have other reservation value than P. And so this term over here, and I believe Ben will go through that next week, will depend on the reservation value of your counterparty.
Okay, thank you.
Yeah. So it's very important. What you say is very important, because you put your finger on one key simplification that's created by those by the perfectly competitive interdealer market. That simplification is not unlike the one that Lagos Wright obtained when they had trade in centralized market. So, okay, so the last thing I need to mention is that when you take derivative of this equation, you find a very nice expression for the derivative of the reservation value. But the one thing I would like to emphasize about that expression is that it's strictly positive. So you find the natural result that investors with high delta have higher reservation value, are more willing to pay for the asset. So that monotonicity is important when we think about market clearing. So to think about market clearing, the way I'm going to go about it is by thinking about gross asset supply and demand, as opposed to net asset supply and demand. So in this setting, in general, you have to think about the net supply, but the gross asset supply is very easy to figure out here, because investors' contact with the market are completely random. They're independent on their state. So because investor contact market independently on their current state, their ownership state, their delta state, then it means that the supply of asset that comes to the market during any small time interval that comes to dealer, the aggregate supply that comes to dealer in a small time interval is representative of the overall supply in the economy. So it's just equal to lambda, the flow of contact of investor with dealer, times S, where S is the probability that an investor owns an asset in the population. And the demand can be calculated very similarly. The demand is calculated as lambda times 1 minus F of delta star, where delta star now is the delta of an investor whose reservation value is equal to the interdealer market price. So remember, the reservation value are increasing in delta, and what that means is that when an investor contacts dealers, he or she will buy or leave the market with 1 unit of the asset if its delta makes his or her reservation value greater than the price. But when you stare at those two equations, aside from the delta, which cancels out, you can see that the supply and demand equations are the same as in centralized market. So what that means that we'll have the same properties as in centralized market, that the price will be set by some marginal investor. And the marginal investor will be exactly the same as in the centralized market. So delta star in this slide, the same delta star we had earlier in the centralized market. The price will be different because the mapping from delta star to the price is going to be different, is going to be determined by this reservation value function we saw on the previous slide. So the marginal investor is the same, but the price is different. So to solve for price, what I'm going to do is use the HJB equation, stare at the HJB equation and note. So, you know, that kind of staring and guessing is something you learn to do by getting used to that type of model, that the HJB equation for reservation value mean that reservation value can be interpreted as, in present value terms, as the sum of two terms. One is the present value of utility flow that an investor derives from holding the asset between 0 and some random time, tau, where that random time tau is the next bargaining adjusted time with dealers. It's a time that's exponentially distributed with an intensity lambda bargaining adjusted multiplied by 1 minus theta. And the second term is the value that the investor gets by selling or effectively selling his or her asset in the interdealer market at price P whenever he or she contacts dealer. So it's how much you enjoy the asset from now until you contact dealer plus the interdealer market price. For the marginal investor, the left side, the reservation value, is equal to the price. So we can manipulate this equation, simplify it, and end up with, you know, an annuity-like formula, just like we had when we studied a centralized market. The price equal to 1 over R multiplied by something. So that something is, it's more complicated, but conceptually it's very close to what we had in the case of centralized market. That something is interpreted as the average value you derive from holding the asset between now and the next time you contact dealers, when the time is appropriately adjusted for bargaining power. So that formula is very nice because you can see that if lambda 1 minus theta is super high, it goes to infinity, then, you know, the average utility flow you get from now until next time you contact dealers is just your current utility flow. So you recover the valuation price. P becomes equal to delta star over R. But if lambda 1 minus theta goes to 0, if it's very low, then it takes forever to contact dealers, so tau is equal to infinity. And what do you get here? Well, you get the average buy and hold. You get the buy and hold utility. You get the average value that an investor derives from holding the asset forever. And so that's the sense in which search friction allows you to move smoothly from the buy and hold utility pricing case, which occurs when lambda 1 minus theta is close to 0, to the centralized market pricing case, which occurs when lambda 1 minus theta goes to infinity. And the impact of search friction on asset price will depend on whether or not the buy and hold utility pricing case price is larger or smaller than the centralized market price. So when we did centralized market pricing, we found that the centralized market price was higher than the buy and hold utility of everyone. But that, remember, it was under a certain assumption that S, the supply, was small. So in general, you could find that the buy and hold utility price could be lower or higher than the centralized market price, and correspondingly, you can find that search friction or reducing search friction, so increasing lambda 1 minus theta, could either increase or decrease asset prices. And the reason we have opposite impact on asset prices is that what you do when you increase lambda 1 minus theta is increase the option to retrade for the marginal investor. But the marginal investor has two options, right? If the investor holds the asset, then the option to retrade is the option to sell the asset later on. But if the marginal investor doesn't hold the asset, remember the guy is different between the two, then the option to trade is to buy the asset later on. So increasing lambda 1 or theta increase the option to retrade, and the option, it increased the option to sell, that tend to increase the reservation value of the marginal investor, which also increase the option to buy, and that tend to decrease the reservation value of the marginal investor. Which option is more valuable to the marginal investor? Well, after some calculation, you discover that it depends on whether or not delta star is higher or lower than the average delta. So it's a very simple condition, and that very simple condition, the way to interpret it is, if delta star is greater than the average delta, it means that when an investor, marginal investor, considered to buy the asset, he or she expects that at the next switch of utility, his or her utility will fall. In other words, if that investor buys the asset, he expects to be a seller. And that means that the option to sell is more valuable for him or her. And that means that when you increase lambda 1 or theta, the marginal investor ends up having a higher reservation value, because he expects that next time he or she will not be indifferent between trading or not, will be a seller. So that's the key. That's the key condition for search friction to reduce asset price, and for reduction in search friction to increase asset price. So in the last 10 minutes, I'm going to go through liquidity measures a little bit and speak a little bit about extension. So I'd like to discuss 3 liquidity measures in this node: the volume, the liquidity yield spread, and the bid-ask spread. For that, I'm going to assume for simplicity that the CDF of type is continuous. So what's the volume? So to understand the formula for the volume, or get a bit intuition regarding that formula, I want to first derive the volume in the centralized market, because that's very easy to figure out. So to understand the volume in the centralized market, note that at each instant we have a flow gamma of asset holder who switch type, and those asset holder move to a type that makes them want to sell with probability f of delta star, because they sell if they draw a new delta that is below delta star. So that means that the volume is equal to gamma times S, the supply of the asset, times the probability that an asset holder switches to a seller type upon switching type. In the semi-centralized market, after a bit longer calculation, one can come up with a very similar formula for the volume. And the difference is that the formula is adjusted by a factor less than 1, lambda divided by lambda plus gamma. So that means that volume is smaller in the OTC market relative to the centralized market, and it's smaller because it takes longer for investor to contact the market. So that's a property of semi-centralized market. It turns out that in the fully decentralized market, where everyone searches for everyone else, that result is no longer going to be true. So we can have volume in excess of the volume in centralized market. Let me speak quickly about the liquidity yield spread. So there I need to make a little bit of a judgment call and to define what would be the yield spread. So, I'm imagining that the asset is a bond, and I'm imagining as a benchmark that the centralized market price, delta star over R, is just the present discounted value of the cash flow of the bond. So I'm identifying delta star with the cash flow of the bond. So under that assumption, the natural way to think about the yield spread is as the adjustment you have to make to discount rate for the interdealer market price to be equal to the present value of the cash flow of the security. So after a little bit of algebra, what you find is that the liquidity yield spread, so on the left side is not exactly the liquidity yield spread, but it's an increasing function of it, has satisfied the formula that you see on the slide. And that formula has a number of interesting comparative static. It's decreasing in, oh wait, so first, two things. The liquidity yield spread is not necessarily positive. And that just mirrors the result that we had earlier, that price can be either higher or lower with search friction relative to centralized market price. Another observation about the liquidity yield spread is that it is not zero even if dealers have no bargaining power. So even if dealer has no bargaining power, which is the ideal situation for the investor, there might be a liquidity yield spread. Why is that? Well, it's because when an investor buys the asset, say, she anticipates that at some point she might change type and not derive, the marginal investor utility flow for a while until he or she is able to trade with dealers. So the market price has to capitalize some version of the present value of those deviation of utility flow from the marginal investor utility flow that successive buyer of the asset are going to incur whenever they switch type, are not able to contact dealers instantly. So if the liquidity yield spread is positive, which looks like the realistic case, one obtained that it is decreasing in lambda, so less search friction, smaller spread. It's increasing in the bargaining power of dealers, right? So more bargaining power, larger spread. It's increasing with gamma, right? So if the investors switch type more often, then it would make larger spread. And remember, and that goes back to this intuition that those spread reflect the present value of those deviation of utility flow from the marginal investor utility flow whenever you switch type are not able to contact dealers immediately. And it's also increasing in the expected deviation of utility flow from the marginal investor utility flow, which you can interpret as some kind of distress cost of the marginal investor. So we can derive a similar formula for the bid-ask spread. So the bid-ask spread would be deviation of the transaction price. So remember, P is not the transaction price. I did as if it were the transaction price number of slide, but what allowed me to do as if is because I could bargain adjust the intensity, the search intensity. But now, we have to think about the actual transaction price in the model, and there's a spread over the interdealer price for buyers on the ask side and a price spread for sellers on the bid side. So you see the formula on the slide. I would like to make just a few comments about those formula. One is that it's multiplied by theta. So now the spread over the interdealer price are zero if the bargaining power is zero. So it's that's different from the yield spread. So it means that change in bargaining power tends to have different impact on bid-ask spread and on yield spread. So that's important when you want to think about calibrating the model and identifying parameters. The spread, the bid-ask spread, depend on some sort of tail expectation, right? They don't depend on the average deviation from the marginal investor type, but the average deviation conditional on drawing a type above that of the marginal investor if you're a buyer, and below that of the marginal investor if you're a seller. And the reason that is so is because those bid-ask spread are they're proportional to surplus of trade. So these are upper deviation from the marginal investor utility flow when you buy, and lower deviation from the marginal investor utility flow when you sell. The yield spread is more of a forward-looking measure. It represents the expected deviation from utility flow when you switch types. It could be above or below. And finally, I would like to mention that those bid-ask spread are asymmetric. So it could be that we have a bigger spread on the ask side on the bid side. In other words, the interdealer price is not always equal to what people would call the midpoint in those models. And we have one comparative statistics that is different from yield spread. We have that bid-ask spread tend to decrease in the speed of type change, whereas yield spread were increasing the speed of type change. And the reason is that, again, it's because the bid-ask spread represents surplus. And so if investors change type very often, then there's not much surplus between the marginal investor and an investor who has a little bit higher type today. And because both expect to switch type very quickly and revert to the mean. All right, I think I'm almost out of time, so I'm going to go very quickly on the next slide. Maybe I'll mention one thing. I'll speak about alternative price setting mechanisms. So I assume Nash bargaining, we're all used to Nash bargaining in search models, in Lagos Right, in DMP. Is that a good assumption for OTC market? Well, it's certainly a convenient one, but you know, in modern OTC market, it turns out that people can trade differently than just bilaterally. Often case, they make several dealers compete for their trade. So investor would request the quote from several dealers, and dealers would you know, send quotes, and sometimes they don't send quotes because presumably they're busy doing something else to investors. So in that case, is perhaps more realistic than what we've done before, but it still can be addressed with the tools from search theory, because it means that the pricing mechanism is essentially like in Burdett and Judd. And it turns out that, you know, all the calculations we've done before continue to hold as long as you replace theta by the probability that an investor received just one quote from a dealer. There's some additional prediction that comes out of this model, for instance, about quote dispersion, conditional on delta. So now investors do receive different price, may receive different price, even if they have exactly the same delta, even if they have the same observable characteristics. All right, so I'm going to stop here. There are many things you can do with a semi-centralized market setting. Here are some of the reference. This is just a small part of the literature. These mentioned just papers that use a semi-centralized market setting as opposed to other models of OTC market. What you'll do next week with Ben is move on to a more sophisticated version of the model where trade is fully decentralized, meaning that everyone searches for everyone else, including dealer. It turns out it's an important model as well. It allows you to think about the emergence of intermediaries. For those of you who think about interbank market, that's the appropriate model. To think about trade between dealers, that's the appropriate model. And to think about all-to-all liquidity as well. All right, so I'm going to stop here and take any questions.
Thanks a lot, Pierre. So if anyone wants to ask questions, or we'll open this to discussion.
I'm Hong from University of Missouri again. I have kind of minor question. So
yeah,
you mentioned about the Burdett Judd, and
yeah.
And I don't know much about the literature in the OTC market, but is there any paper? I haven't seen a paper that used the Burdett Judd pricing in the OTC market. And also, I haven't seen the paper that using the price posting like directed search in the OTC market. And are those, if it resembles some of properties in the OTC market, then is there any papers? Are there any papers?
So on Burdett Judd, there is a recent paper that's forthcoming in the Review of Financial Studies by Glepkin, Ueshen, and Shen, they call it multilateral search, but that's it's very close to Bert Judd. I had something on Bert Judd in my review paper a couple of years ago. And then very related is the work of Ben with Ariel Zetli-Jones, Ali Shuride, and Venki Venkateswaran. Okay, so I guess I do in reverse alphabetical order. I went in reverse alphabetical order here in the JPE to think about asymmetric information. So it's not, you know, in a dynamic OTC market, but it's very related. On competitive search, there is some work. The way the first application of competitive search to OTC market, I think, was due to Brianna Chang on the one hand and Gary and Scheimer on the other, and they used those competitive search models to think about trading under asymmetric information. Have some work with Ben Lester and Guillaume Rocheteau also on the topic, which was maybe a bit, does not deal with asymmetric information, but develop the toolbox. One of the G paper that's mentioned over here by Kaga, Passadori and Silva also uses competitive search. So, you know, it's being used. Not, you know, there's probably still quite a bit of work to do on that. Because as we know, competitive search, oh wait, Santiago also had competitive search, I think in his master's thesis. I should have added, yeah.
I did,
yeah. Go ahead.
No, yeah, that was true.
Yeah.
A quick question.
Yeah.
So this was, I think, Marie mentioned this, you know, she alluded to this, that these search models are kind of, we always look at the steady state equilibrium where there's no aggregate shocks.
Yep.
And, you know, of course, we have this thing where we can look at one-time shock and kind of perturb the equilibrium out of the steady state equilibrium. Do you know any papers where they look any kind of search type models where there are aggregate shocks that are constantly hitting the economy? Let's say like we want to look at, you know, some kind of shock, you know, some stochastic process on the interest rate, let's say.
Yeah, so I think Kaga, Passadori, and Silva offer some method for that. You use a perturbation method to think about that, but there's no much that's been done on the topic. Yeah, you're right that am I forgetting someone? No, I think, you know, for the most part we've done steady state analysis or you know, one-time shocks or one-time shock and, you know, another shock that goes in the opposite direction. You know, things that can be solved by backward induction, basically, and not fully recursive dynamic stochastic systems.
Here isn't your paper leaning against the wind, kind of in a.
But that's a MIT shock, I guess, as people would say. It's just a one-time shock. Yeah. Oh wait, so yes, so there is a treatment of recurrent shock in the Duffy-Gallagher person 07. It turns out they have recurrent shocks, but it's a bit special. So, you know, but they gave one treatment of that.
I'm not sure related, but I think that Lucas Herrenbrooks and Atanasio Mitchell also have the kind of embedded in the neoclassical growth model to the search model. You have aggregate shocks and you have Taylor rules. Maybe.
So sorry, I missed the reference.
So the Lucas Herrenbrooks and
yes, that's right.
They made the neoclassical DSG model.
Oh, that's right. Okay.
So I think that could be the part of the model that she just mentioned. So you have all the aggregate shocks, and you also have the dynamics.
Yeah.
Not only aggregate in the sense of one-time shock, you just have different occasions that have stochastic shocks that are hitting the system. So
no, so absolutely, and then you know, I have there's a UCS student on the market, student of under Eisfeld 9, Wu-Feng Chang, who also has who integrates OTC markets for corporate debt, a little bit like Hay and Milbrat, into a macro model, and also has aggregate shocks. We have aggregate liquidity shock, and look at the propagation of that into the real economy. So there's been some work, but it's not, you know, it's somewhat not at the center of the literature. It's not that like in the labor literature where in 2005 we had this, you know, enormous this tsunami of paper working on the business cycle implication of Belmont and Pissarius. I've not seen something like that in the OTC spectrum happen. But yes, no. So we have to give credit to a few papers who have tried to address those issues.
I have a quick question. So it's Gabriela from Universidade Autônoma de Barcelona.
Yeah.
Okay. So you talked a bit about the evolution of the literature. Do we know when these OTC markets actually start to arise in reality? And is there a common narrative that why they start to be like, why they emerge or not?
All right. So what can I say about that? So there's two things that come to mind. So one is all right. So one would have so if you look at say the history of CDS markets, people would say that it starts OTC. You know, it's like it starts with bilateral transaction for contracts that are not very standardized, and then little by little, you know, trade start becoming intermediated by dealers, etc. So there's this vision that, you know, when innovation are in their infancy, it's more OTC, and then as standardization occurs, etc., there's also a process to move trades towards mechanisms that are less and less OTC. But there's this other paper, I'm sure many people, Batchman has it in mind, by Bruno Billet and Rick Green, that showed a bit counterintuitively for everyone at the time that we saw evolution going in the other direction. In corporate bond, they argue that most of corporate bond markets were traded in centralized exchange prior to the Second World War, and for reason, and they argue about possible reason, but the paper is mostly narrative, historical, and empirical. Most of the trade moved towards dealer intermediated OTC market after the Second World War. So that left a lot of people puzzled as to, to think that it's unavoidable that, we move towards more and more centralized exchange, and OTC are doomed to be a footnote in the history, but it looked like it's the other way. Yeah.
Sorry, I missed the reference. Which paper is that?
It's by Billet and Green. You can write me. Anyone, please write me if you want clarification, references. I can send them back to you.
I read also that a lot of sovereign bonds, even like in 1800s and 1900s, they were trading at exchange.
Yeah.
On the London exchange. Yeah. It seems like one explanation is regulation, what determines which assets end up trading OTC versus exchange, right?
Yeah, go ahead.
Some intersection of regulation and how amenable the asset is to be traded in exchange. Yeah. Right? When that could include, like you said, like the supply of the asset and so on.
Yeah.
Yeah.
No, so one would think, for instance, that making some derivative more standardized would naturally create complementarity with exchange trading, for instance.
Yeah. And then related to what you were saying, like if you have some financial innovation, a new instrument, and they may start trading OTC. One that's a little different is cryptos, right? They're trading on exchanges, even though they're very new and anyway.
Yep. Okay, it's a good one. Yeah.
So it's a puzzle still, I guess. The takeaway. Yeah.
Yeah, it's a bit of a puzzle. The boundary between the two is more blurry than it looks, you know. So I mean, there's another argument that says, look, you know, this is just a model of a trade where not everyone is in the market all the time. That's it, and that's kind of true of all market, presumably. Right. So let's not puzzle forever about what's OTC, what's centralized. You know, we're probably close to centralizing many markets, but we're not there exactly. And to think about transaction costs, intermediation, we need to contemplate deviation from the valuation auction. That's it. I mean, that would be a bit more pragmatic approach to that question. Not to dismiss the other one. I think it's a fascinating one too. As I said, it's important if you want to think of counterfactual policy, etc., because you need to understand the demand for speed, for immediacy. What is there in OTC market for investor is fundamental to understand, to evaluate the impact of policy who remove OTC market and replace it by something else.
So if other students don't have more questions, can I ask you another question? What would you, if you could like give advice to students who are still around, you know, if they're looking for research topic, what would you recommend to them? Maybe like first broadly in OTC literature. I know like there are a lot of open questions still, but what would you say is more pertinent? More broadly first in OTC literature generally, and then maybe more narrowly to search theory.
So in OTC market, more generally, I'd say, so my own impression, and maybe that reflects what interests me these days, is that there have been 20 years of, almost 20 years of theorizing in OTC market. So we have a bunch of models on the shelves now. So a lot of effects and interesting theoretical questions have been studied. And what's a bit still unexplored, and although they're been explored to some extent, are the quantitative implications of these models and making those models establish closer contact with data in general. So there's a lot of interesting data that's, Carnegie started the data work on that on OTC market, and that came after the theories were developed. And understand better what kind of model is appropriate, what are the implications of the model for policy analysis, etc. All those questions I think are very interesting, and certainly not as developed as the theoretical questions. Another area that I find particularly interesting has to do with integrating those models in broader general equilibrium frameworks. So that, in a way, it's been the agenda of the monetary literature. One interpretation of the monetary literature is in this way of doing general equilibrium with model of decentralized exchange. Often it was in goods markets, but there's a number of models do asset market. Shenzhen as an important area on the topic, for instance. But I think this is exciting. It's also important. Just to, I showed you in OTC market are large now. Okay, why do we care for macro? And just trying to explore those questions quantitatively more systematically, I think is very interesting. So this paper by Wei-Feng Chang I mentioned, does that, for instance, in the context of corporate bond by studying the macroeconomic impact of liquidity shocks, for instance. Saki Bijou has worked a bit on that topic as well. So that's related to, I think, things that Ben will speak about next week on related to interbank markets. So I guess the spirit is, there are some big markets out there that are organized over the counter. Why do they matter for macro, and for which macroeconomic question do we care about those markets, and what are policy implications, etc. I think that's also a very exciting area of research. So, but I'm sure, and I'm sure going, to more into those quantitative questions, data questions, will bring new theoretical questions to address. So that there will be a back and forth. But for instance, Santiago's has this great idea of thinking of patent market, for instance. So that looks like a nice area of research. So that's this is where I would pay attention, but of course I might be wrong, and I might overlook other very interesting areas as well. So. Oh,
you're muted, but
you're muted.
I'm going to stop recording and just leave the room open. And thanks again, Pierre, for super clear and very nice lecture and all your
Thanks for the
answers.
invitation.
Yeah.